Hey there, welcome to the channel. So today I want to take a look at the GDP. All right, so we got our second quarter GDP and it ends up being another negative number. So it decreased at an annual rate of 0.9% for the second quarter. In the first quarter, it had decreased by 1.6%. So we got that 2 quarters of negative GDP. One thing you can note is that they're pretty shallow. It's very shallow um, decline in GDP right now. So one of the things that we could look at is let's go look at the contribution from the different pieces that make that up. Because when we looked at the first quarter, what was kind of interesting is a lot of that had to do with the imports and exports. Um, so the table I'm going to go to is not this one. I'm going to go to table two. And what this table two is telling me, at least based on the title, it says contributions to percent change in real GDP. Okay, so what we could do is, so for example, in the first quarter, minus 1.6, and this latest data, minus 0.9. And this will tell you like which section, how much it contributed to that number. So for example, row two, personal consumption. So personal consumption was 0.7. So we can see that the personal consumption, had dropped, but it was a positive 0.7% to the GDP. So now we can look at that and we can look at three, and there was a minus 1.8 for goods. Okay. And for services over here was plus 1.7. So you put them together and you end up with 0.7 positive. Okay. So you had strong, relatively okay growth in the services, but yet on the good side, it was a negative number. So let's go down a little further. Let's look at this is where it's going to be the deal here. So if we look here, gross, number 26, gross private domestic investment. So this is really a big negative contribution this quarter. Okay, so that minus 2.73%, that's a big one. And if you notice over here, it was a positive contribution in Q1. So it's really interesting. So what this means now, fixed investment is minus 0.72, and change in private inventories minus 2. Ooh, so that was a big negative. And so that was a big negative contribution overall. So this gross domestic investment. So it looks like this was related to inventories as well as being a big negative component of it. But the overall effect is that your investments have gone down in this quarter. So it's almost as if the companies and the people that are doing some types of investments have pulled back, and that is minus 2.7. That's the biggest number you're going to get in terms of looking at it. You're saying, hey, minus 0.9, where did it come from? Well, you have a positive 0.7 from goods overall. You have that investment minus 2.73. That's your negative number right there. And notice that it was positive in the previous quarter. So what the point is that this has changed, right? So if you look at the net exports over here, 43, and you look at the overall, see, this was why we had the first GDP negative quarter. We had this huge net export negative number. So basically what happened is we had a bunch of imports coming in and very little exports. But see, that's swapped this time. Right now, our exports actually grew and had a positive contribution while the imports had dropped. So, it's all kind of surprising. Now, maybe so the characteristic of why we had negative GDP somewhat changed between Q1. A lot of it had to do the import export, right? But over here, the import export was a positive contribution. The negative number came from the private investment. Okay, so it's a very different kind of thing. Now, in both of these quarters, you can see that the government consumption and expenditures were both somewhat small negative numbers. So I found that interesting. And so in that summary is the reason we had the negative GDP was primarily due to investment. Okay. So that's something to kind of keep in mind there. It's different. It's almost like the Q1 is sort of a little bit more of a fluke of the import export. Now, given the fact that we have, we're primarily import a lot of stuff. We do export some stuff, but we're mostly an import country. I wonder if we got lucky here. And so a little speculation. Is it possible that we would have had a big negative number here because on the imports, look at we had lots of imports in the first quarter, but here it dropped off. Now, did it drop off because of all these issues with China closing down ports and things like that, where we haven't gotten the imports come in as much as in the first quarter because of all these shutdowns due to the zero COVID policy and all that? That's an interesting kind of question because if you look at it and you say, okay, look, if the private investment comes back in the next quarter, okay, however, but if our imports start coming back and the ports start flowing more, then you're going to get pressure from this side. So, in other words, looking ahead to try to figure out if you're going to have that third quarter of negative GDP, the imports could be a significant factor in that. So, that's it for a GDP. Whether we're in a recession and what that means, hey, look, you got 2 quarters negative GDP. I know, Biden administration trying to point out that we're not in a recession. The thing is, it's always been that way. So when you go ahead and you look at charts, right? You look at charts and it's like, oh, here's where the recessions are marked. Here, the gray bars here, you look on Fred, look at everywhere. These are by the NBER. They declare when the recessions are. The thing is that they're always very late. They tend to very often declare that we're in a recession after we're out of the recession. And I saw this back, I think it was in the Great Financial Crisis, back in this time here. I think it took a very long time. We're talking like a year or more for them to actually say, oh, yeah, we're in a recession. That may be wrong, but it can take some time, and they do look at other things. So that aspect in its own has not really changed. I know that's creating a lot of controversy, but I just think that that hasn't changed. However, there's signs that the negative GDP is pointing to, that people are struggling. There is kind of this issue. And given that, when you look at this and you see this drop in private domestic investment, that's kind of points to trouble in the economy going on the forward basis, right? Because, these investments that they're making, they're cutting back and that would cut back unemployment and all that stuff. So that's not really a great sign for that. Now, what was interesting is that the way I viewed this, and I'm actually just thinking like, hey, look, right now we've essentially had this rally coming out here, right? So we've had this rally coming out of the Fed 75 basis point rise, right? So we've had this rally here. We really put in 2 good days, and we've kind of like broken above near-term resistance here. So my thoughts on this are that, hey, look, I think you can easily make an argument that we could be due for a little bit of a rally time here. And this is not financial advice. It's just from my point of view, it's like, hey, look, we're overdone. Everything's been sold. We're seeing this stuff kind of pop up. And, right here too, if you're looking at the cues, you just popped out of here, came out to here, and you're right at the door of this one, which would put you into, yeah, I know there's resistance there, resistance here, but, you potentially could get, a little bit of a rally here is what it seems to me, because like we've gotten a lot of the bad news out. We had the CPI come out, the Fed rate rise. We don't have another Fed meeting in August, I believe. You can check on that. So we could actually be kind of quiet for now, and that quietness and lack of bad news maybe could be a positive thing for the market. So I'm sort of leaning towards I'm leaning towards possible bullish moves in the market right now. Interesting, like how your the Bitcoin here is it's looking like it wants to come up, right? So you basically have a consolidation period here. It broke out and then came back down, really resistance at this 2400, but look, it's trying to rally again. So but all, as well, because that's what the Nasdaq is doing, and they're pretty well correlated. Interesting one too is on the 10 years. Look at this guy. I mean, it's like a little, we're breaking below this 2.7% on the 10 year. So this is the other thing that's going on. So I'm looking at it, I'm saying, like, well, we might have a decent little rally. I don't know that this is a bottom in the market. I wouldn't call it that, but like, look, if our rates start falling off here, they're breaking through this. You got a little head and shoulders. Where is our support going to be? I mean, maybe have some down here, maybe have some down here and here at these different points where you had some consolidation going. So you could see that, rates could drop off significantly. We could be back below 2% possibly in a month. Now, if that happens, that would be quite interesting. That could be very bullish for the market, and that could actually kind of turn the taps back on for the housing market. It might relieve some of the fear that's going on with that right now. And it's setting up, like on this chart, you can see there's kind of this setup for rates to go lower, which bonds go stronger. That's just what I see. Another one on energy is interesting too. Our UNG had really had this huge run and it's came off, and it's coming. It's almost kind of channeling and stuff. But I mean, we'll see on that guy. All this stuff going on with the Ukraine and the gas, and oh gosh, what a mess. EU is destroying themselves. Oil persistently high. Dollar, still hanging in there, high, but it's come off from its worst ones. Now let's just take a look at a couple other things. Apple today, after hours up 3%. Meta kind of down today, but up a little bit after hours. So not much there. Looking at the Voyager Digital, one thing with the Voyager Digital. What's interesting, I found this in there. So basically on the docket, there's all this stuff is filed. Everything's filed from letters from people that are complaining and everything. But this is an interesting one. So this is a filing about declaration of status as substantial shareholders. So this is that guy, blank. What was his name? Yeah, this dude, Sam Bankman Fried, or Sam Bankman Fried, I'll call him. Okay, so this guy, well, they're notifying that his Alameda Ventures has 7.7 million shares of Voyager, and Alameda Research has 10 million. So these are rather large numbers of shares. That's kind of interesting there. So that this was filed yesterday. So this guy's got a lot on the hook. So as you know, I've been saying is like the Alameda is like they have a lot of money in there that they're not going to get out. Most likely, you're not going to get that money out. The money is gone. It's disappeared. It's evaporated. And I'm not a lawyer and I'm not giving financial advice, but just my perspective on it, being involved in one of these things in the past, I could tell you it just looks to me like boom, it's not really good. So this guy's going to be under a lot of pressure. So this guy, in my understanding, and you can correct me if I'm wrong, but this Sam guy is he's also behind FTX, and you just kind of wonder if that's going to put pressure on that. In other words, if that company is looked at as a place to go out and like, hey, do some buying of other companies that are having issues that have gotten into trouble, that may not be the case because he's under financial stress here. He very well could be under financial distress. Something to keep in mind. So let's look at one more thing. The Fed. I just wanted to look here at the total assets of the Fed. I haven't checked this in a while. And you can see the big deal. Always going up, always going up. Financial crisis, boom, buy a bunch of stuff. Buy a bunch of what? Treasuries, mortgage-backed securities, and crap. And then they've kept it going, and they kind of flattened and started to bring it down here, and then boom, they started to bring it back up. So they must have been having some trouble there in 2019. And what happened, then we had the Cerveza thing, and they just went crazy with printing money. But the point is, in more recent times, you see how it's rolling off. So we can start to see on this recorded data that the Fed is appears to be reducing their balance sheet. So let's go zoom in on that. Yeah, you can see it right here. You can see that, it's coming around the curve here, and it's slowly they're trickling off that balance sheet. And it's kind of an interesting thing because if you look at this, it's not a 100% correlation. Now, there are different scales. So I have the assets and S&P times 1,000 to try to get just because they're on different scales. I don't have a secondary y-axis that I could use here. But you can see that there seems to be a lot of reasonable correlation between assets and the balance sheet in the market. Look, when you look at it here, I mean, you look at these very particular cases here, the stock market was going to crap. It was imploding here as because of the shutdown for Cerveza, and they just pumped it up and got the market to just come right out and keep going. And so, I mean, it's very clear, and you can see it in other cases. So this orange line, I'm sorry, is the S&P 500. You can see other times here where this is dropping off, and correction or slowing down, and then right at this point here, you see, boop, the market starts going up as they start putting money back in, and you can see this over and over, and there's longer term charts of this. But what's interesting here is you can see that the market is coming off. I think expecting that this is rolling off, and now that it's rolling off, this is continuing to come off right here. So it's really hard to say, but I mean, it does look like there is like kind of that correlation between the assets. And so why? Because, the Fed increasing the assets. I mean, what are they doing? They're printing reserves, and they're basically taking those mortgage-backed securities. They're buying the mortgage-backed securities and treasuries, and what that does, just puts bank reserves and cash available at the banks. And so, like, if you could imagine that, like the Federal Reserve, I'm sorry, the primary dealer banks, if they only have so much resources available to bid for whatever 200 billion a month, and then if the Fed comes in and takes some of that off, then it gives them more resources. And so that's why I think you do see that action where in the market. I mean, it's a very correlation. I think going into the weeds of the you can debate the crap out of that as well, but that's just what I see. So I think that will be it for today. I'm leaning towards, personally, just a little more bullish at this point. And it's not that I'm long-term bullish that we're going to go to new highs. I just have this feeling that that what's going on here is that it depends. I mean, it could crash tomorrow, but we could be it looks like we're going to try to make a run at this 415 on the SPY. And I could easily see a case where we put in some more of a sideways and upwards motion in the market right now. All right, that's it for this one. Bye.